Welcome. I'm Ashkan Zandi, Chief Intelligence Officer at CREtech. Thank you for joining us for our second CREtech Talks, Perspectives in the Time of Uncertainty. We will be hosting this series here every Friday starting at 12 noon Eastern Standard Time for the next several weeks. The goal is to check in weekly on the state of commercial real estate tech and the built world in the wake of the recent pandemic. In the coming weeks, we are planning a session around M&A, check-ins on European PropTech venture capital, talks about leading thought leaders in the crisis, and hear what our owners, investors, and the real estate tech community has to say. But we would like to start our session today with what our community actually wants to hear. So if you have any questions, please tweet us at Discover CREtech or email us at research@cretech.com with questions that you would like answered. While everyone is logging in and getting set up, please let me update everyone on a few developments from CREtech. On April 14th, we'll be hosting a webinar with our friends at Freshworks on automation and engagement for owners, managers, and real estate professionals. On April 21st, please join us for our CREtech Virtual Demo Day, where you'll hear from 6 of the most exciting tech companies and their innovative solutions transforming commercial real estate. And of course, we hope you will save the date and join us on September 30th for CREtech New York. To find out more about any of our events, please check us out at cretech.com/events. I see that we have a huge crowd already getting logged in here, so let's just get started. In the midst of the recent pandemic and the economic conditions impacting real estate tech startups and investors, today we will be hearing from 4 of the most insightful and active venture investors in real estate tech as they discuss their perspectives on the impact of the pandemic on our industry. Please join me in welcoming our esteemed group of panelists: Daniel Fettner of Corrigan, Merritt Hummer of Bain Capital, Dave Eisenberg of Zig Capital, and Travis Connors of Building Ventures. And it's also my pleasure to introduce today's moderator, Steve Weikal. Steve is a thought leader in the future of technology, innovation, and commercial real estate. He is the head of industry relations at MIT Center for Real Estate. Thank you, Steve. The stage is now all yours.
Thank you for your help in setting this up. Also, thank you to Michael Beckerman and the terrific team at CREtech for providing us a flat platform to have this really important conversation. Importantly, I also want to acknowledge that not only are we talking about a global economic crisis here, but also a significant human crisis. There are thousands of people joining us from around the world on this webinar. Each of you are doing your part during these challenging times, so thank you for that. This also includes our expert guests today, who I'm honored to have with us. Daniel Fettner, who is a principal and chief of staff at Corrigan Ventures. Corrigan is a New York City-based seed stage fund that invests in a variety of startups, including consumer services, prop tech, marketplaces, commerce, infrastructure, and logistics. Corrigan also has a real estate group that's involved in development, owning, and operating real estate in New York City. We'll talk about that a bit. Dave Eisenberg, a founding partner of Zig Capital, which is a relatively new venture capital fund that invests in emerging technology companies in real estate and construction. The current portfolio includes about 18 companies. And you may also know David. He was the founder of Floored, which was an early prop tech company later acquired by CBRE. Merritt Hummer is a partner at Bain Capital Ventures, which is the growth equity arm of Bain Capital, which manages over $80 billion in alternative assets globally. Merritt focuses on growth stage investments across sectors, with a particular focus on fintech, real estate tech, and consumer internet. And last but not least, Travis Connors, co-founder and partner at Building Ventures. Building Ventures is focused on investing and mentoring early stage startups in the built environment space, including AEC tech broadly and real estate tech. And Travis has been around startups and venture investing for a number of years. So Travis, I think I'll start with you. Can you help us put this situation now, this COVID-19 situation, in context? How does this crisis compare to what we saw in 07 and 08 and perhaps even 01 and 02?
Sure thing. Happy to start, and appreciate the opportunity to be with everybody today. So I've been investing in technology companies since 1995. So I had the experience with call of living through those previous two crises, and I think one of the things that distinguished them is those were both caused by asset bubbles that had to do with structural flaws in financial markets. You know, and so while there's some similarities to what we're all going through from the economic dislocation perspective, the reality is that this is more like a natural disaster, and I think of it as being more like a hurricane that hit, and we are still in the middle of that storm, and so both cause an enormous amount of uncertainty. In previous generations, it was when will we fix the structural issues? When will we get the reforms necessary to begin to repair the economic engine and get that going again? Financial markets, particularly credit markets, hate uncertainty, and so tend to tighten up now on our own. But the reality is we're still in the middle of the storm. And until everybody feels like it's safe to go back out and begin to work, we're going to be stuck in this period of uncertainty for however long that goes on. I'm really optimistic that once the storm is past and people feel safe, we'll recover more quickly because we don't have the underlying structural issues with the economic engine that both need to be fixed. Now it's just sitting idle and waiting to be restarted again.
Right.
And
so and obviously it's still very early. To all of our guests, I'm sure you've had calls and emails from founders and investors and LPs. And are any of you sensing any panic in our particular world of real estate tech at this point, or is it still too early?
I'll go. I think there is some panic. I think it's highly divergent based on how exposed you are to the shutdown. But there's been a tremendous demand shock. If you're a business in the travel and hospitality space, it's possible your revenues went to zero overnight. If you're a business in the retail sector and you're closed right now and you don't have an e-commerce delivery like with healthcare retail or something similar, again, this is unprecedented in modern economic history where the revenues have gone to zero from what could have been exceptional growth prior to that. So in those categories, you're seeing panic. I think companies that were planning to fundraise now or in a quarter or in 2 quarters are close to panicking because valuations have dropped precipitously. Capital markets have shrunk precipitously. Debt markets have tightened in a dramatic way. So I think there's panic there. On the LP community, I think there's some panic for the folks who have had some very large gains that they were counting on with certain names in prop tech. You know, without naming names, you can guess some of the players in travel and hospitality, in co-working, in residential brokerage. A lot of these groups are not worth what they were worth 90 days ago or 180 days ago. And so if you were relying on a future capital allocation because of those gains, I think there's some degree of panic as well.
Yeah, we'll come back to the denominator issue, which I think is an interesting one. But Merritt, can you speak? Bain, you have exposure to not only real estate tech, so can you put that a little bit into context for us as well? On is there panic?
Yeah, absolutely. So I think, across the Bain Capital portfolio, I obviously I'm a partner on the venture capital and growth equity team, but we also have asset class teams covering private equity, credit, life sciences, public equities, real estate as a sector itself, and some other areas. And we have teams covering those asset classes around the world. So in Asia, Europe, and North America. So I think picking up on a thread of what Dave was saying, the degree of panic really depends on each company's unique circumstances. I think what we've seen broadly across the Bain Capital portfolio and asset classes globally is there's been an immediate slowdown in new investment activity and a pivot to focusing on the portfolio. And I think the common sentiment across teams is that the extent to which any new deal activity happens in the near term will probably be either conversations that started before the crisis hit, or potentially entering into deals with entrepreneurs that our team has known for years and already has a pre-existing relationship with. But and then in terms of like whether there's panic amongst the venture community outside of prop tech. You know, I think what another interesting observation we've drawn internally is that it may seem like venture-backed companies are the most vulnerable, and that feels intuitive because, you know, for the most part, they're not profitable. They tend to be small. They tend to be nascent. But at the same time, venture capital-backed companies have some advantages. So, you know, unlike in the venture world, a lot of our companies are invested in by our other teams don't have any recourse in this environment. So they have nowhere to turn other than their existing financial sponsors. There is no PPP program for large private equity backed companies. And so if they've taken on more debt than they should have in this environment, they really have to work it out with their existing sponsors to get through a tough time, as opposed to kind of rely on the government to provide support. Mm-hmm. So I think, you know, in some corners there will be panic that's induced by not really having as much support infrastructure as may be afforded to small businesses in the country.
Great, thank you, Merritt. And we'll come back to the operational level, what we're seeing there, what we might see. Daniel, can you speak a bit about, given that Corrigan is on both sides, arguably, can you speak a bit about being a VC, but also about being a real estate company right now? Maybe not so much about what's happening in the traditional real estate industry, but as it relates to technology.
Yeah. Absolutely. So yes, Corrigan has a real estate business. It's been around.
Hey, Daniel.
For a few decades.
Daniel, we appear to be
vertically integrated in addition to the management team. In terms of the, yes.
Yeah, Daniel, we appear to be having some audio.
Can you hear me, Steve?
Having some audio trouble. Maybe you can drop off of video and just join us with audio, or maybe log back in.
It's that swaying beach scene.
I think it's the swaying beach scene and the breezes coming off the ocean and the waves.
Wi-Fi in Turks and Caicos is different than what it is in New York.
Yeah, different than New York.
Can't hear me now?
Yeah, that's a little better. You want to try it again?
All right, sure. So yes, Steve, Corrigan also does have a real estate business. Been around for a few decades, vertically integrated. In addition to, you know, being and acquiring assets, we also trade across the debt stack. And, you know, I have to hand it to our leadership team. I feel like we've been preparing the company for this type of an environment for as long as I've been there. Right now, the focus is definitely existing portfolio, you know, doing what we can to provide our tenants resources so that they're informed about what their own options are. You know, rent checks are literally due today and Monday, and so obviously that is paying close to that. Smart Build's a tenant platform. You know, I think you should expect your sales cycle to triple, right? Landlords are distracted and implementing new technologies, they just fell to the bottom of their list in terms of priority. So I think we'll also see some short to medium term effects on things like co-working and co-living. You know, I know a bunch of co-living projects that were set to start in Q2, and you have to wonder if consumers are still super excited to live in really close quarters among strangers. You know, my guess is in the short term, the answer is no.
Right. Okay. Thank you for that, Daniel. So has anybody seen any accelerated decisions, deals put on hold at this point? I mean, we're only really a few weeks into this new landscape. Any quick decisions have been made other than the obvious ones in the headlines?
Yeah, I mean, I would say that, you know, we've certainly experienced a number of situations where we've witnessed other investors immediately change their behavior, where they've either paused their investing activity until there's some more clarity, or they've withdrawn completely. Heard certainly about a few pulled term sheets here and there. So I think like anything, there is what Dave and Merritt were saying, some panic around the uncertainty that's still out, and you'll see people slow down in their investing pace. That said, if deals are in progress and people have been working on them for some time, I think we'll continue to see them get done. You know, we just closed on a new one yesterday, so I don't think it's completely shut down.
Mm-hmm. You're all involved in different parts of in different parts of the process in the ecosystem. Can you speak to maybe the difference between companies at different stages? We had this on the pre-call. We discussed how seed stage versus later stage, this might be experienced different, a different experience for these companies. And any of you can jump in here.
Yeah, I can speak to seed stage, Steve. You know, one thing that's interesting, and just to give everyone context on the call, all of our initial checks come in at the seed stage. And so as a team, when we originally went through the portfolio line by line, green, yellow, red, a couple of weeks ago, in terms of who is going to be most severely impacted, what we realized at a high level was that a lot of our companies who had raised funds in the second half of last year, they had already earmarked the first half of 2020 for building product. And so they weren't reliant on incoming revenue as part of their burn calculation. Obviously, as companies mature, you know, and as they begin to monetize, they are reliant on revenue, and that is an assumption taken into account into their burn. You know, I think at a high level, some seed stage companies are fortunate in that they were already focused on their product roadmap for Q2 rather than, you know, monetizing and relying on that revenue coming in.
Mm-hmm.
Yeah, I'm happy to comment on the growth stage. I mean, I think growth stage companies have the advantage in this environment of just being able to offer more data to support a story about the resiliency in a downturn, which obviously doesn't, is an advantage that seed stage companies for the most part probably don't have. So we've been in conversations with a few businesses that you would think intuitively are either counter-cyclical or maybe have lower beta to the market cycles than others, but you may not know for sure. But when those companies can actually share data that shows that they're either neutrally impacted by coronavirus or benefiting from it in some cases, that's obviously reassuring to an investor. So I think growth stage companies have that advantage. At the same time, however, because, you know, usually their investments are for greater dollar amounts, there's obviously a heightened level of scrutiny in this environment to making sizable investments. And so I think it sort of cuts both ways.
David?
I think anytime you see a drop that has been as sharp and as severe in the public markets as we've just seen, you know, a lot of stocks are down 40, 50%, especially in the real estate category. That immediately translates to the late stage environment. And so the late stage companies that may have raised very momentum heavy rounds over the last 24 months are, with pretty few exceptions, looking at doing flat rounds, convertible notes, down rounds, stuff that is a little bit messy in venture land. In the early stage, you see some of that same valuation behavior, but you also just see people saying, I'll just wait. I'll wait until the next round. A lot of investors effectively raise the bar for making a new dollar commitment into a company for which they don't have existing exposure. Mm-hmm. Final thing I'd say is in the early stages, it's hard for investors to develop relationships over Zoom. And so I think, you know, what you find is that if you haven't spent time with a team in person before, it just requires a lot of extra conviction to be able to make a fully remote investment decision. We've only done it once, I think, and it was one where we felt exceptionally confident because of data and so forth. And no one is feeling really confident today. And that's because we don't know how long the demand shock is going to linger for. On the real estate side, the real estate industry doesn't know what's going to happen with rent in April, and they certainly don't know what's going to happen in rent in May. We heard some pretty shocking statistics from the retail industry about the percentage of tenants that are expected to pay rent in April versus May. Mm-hmm. If it's as bad as people think it's going to be, the real estate industry is not making new purchase decisions en masse, you know, for quite some time.
Wow.
Yeah, I would add to that from the, I was looking at some data this morning of a survey of AEC companies and comparing it to a survey they did 2 weeks ago, right? 2 weeks ago, people were expecting 5% of their projects to be delayed. In only 2 weeks' time, we're now up to a third of projects being delayed, and that will begin to translate into projects being canceled, right? And so that sort of downstream dependency, and that's what I was alluding to earlier, is the more exposed you are to the credit markets and credit markets fueling whatever activity you're doing, whether that's real estate development or real estate operations, will impact. I mean, that kind of a shift would be the kind of thing that can wipe out profitability for a huge swath of the AEC market for 2020.
Yeah, TechCrunch said among Europe's startup investors, their main focus for the time being will be managing the cash flow of existing portfolio companies with an eye to cutting non-essential costs. Now, that's not just prop tech, that's broadly. So there's been discussion about, kind of heads down. And also there was a comment about the return of sustainable unit economics, forcing, becoming so important to startups that want future funding. I thought, I mean, you guys, probably all of you were looking at sustainable unit economics prior to this, but does that become even more heightened at this point?
I think that speaking on the early stage, we are always aspiring to sustainable unit economics. They're never that way out the gate, right? And so really what we're looking at is time being pushed out. And what we're discussing with our portfolio companies is we should now be expecting that we're going to need whatever runway we had, we're going to be expecting we need another 6 months in order to begin to see a normalization of behavior after that. In terms of only businesses that can be profitable out the gate or the kinds that are deserving of funding, I don't think that's true. We are trying to invest in things that will have a transformative effect 5, 6, 7 years from now. We are experiencing a dislocation. It will last for some period of time, but it's not going to last forever. It does change. There, as was mentioned last week by Andrew Ackerman, some companies will benefit from the new environment. Some will be hurt by a new environment. That changes the parameters, but there will be still lots of winners.
Yeah, I would just add to that. I think sustainable unit economics are always important, but I think particularly important now because for the very reason that you just can't rely on a subsequent round of funding to continue to fund unsustainable unit economics, which I think prior to COVID, maybe you had more confidence in, and another investor coming in after you and following on to continue to fund a business as long as there was momentum and an upward trajectory. That is no longer the case. And so especially at the growth stage, you have to assume that the money you're providing the company may be the last money in before they become profitable. And in order for that to be true, they really have to prove out the unit economics story.
So we mentioned earlier, I had a question about LPs. This came up last week. Now, I don't know how many of you have, maybe last week we had more institutional LPs, but might we see a couple of things in the behavior of LPs with this denominator problem? They have to rebalance portfolios. And then also, what about the wealth effect with angel investors, given that some of you are involved early stage? Let's step back even earlier. Is this the death knell for angel investing for a while?
Death knell is probably a bit strong.
Okay, a little extreme,
I think across hyper early angel, pre-seed, seed, series A, everyone is recalibrating in real time risk. And risk is, it moves in proportion to reward. And so to the extent that companies have fewer and fewer options for where they can raise their capital from, the way that they increase the success rate, the conversion rate of raising money is by increasing the reward, and increasing the reward translates to reducing valuations. So as crappy as it sounds and feels, the way you sort of keep your company viable from a funding perspective now is you reduce your expectations as to what it's worth. And whether you're pointing to a public market comp to support that, or you're just reporting to a drop in the number of total investors that have risk appetite today, that's how the market balances. If you don't adjust your valuation expectations, you find yourself entertaining existential risk, which is a very challenging situation to be in.
Mhm.
Yeah, I mean, I'd add on the denominator problem, right? I mean, there are LPs that have certain allocations, but I don't think anybody truly believes, to do exactly what Dave is saying, that because the public markets fell 25%, but because we don't have to market our private investments, that those private investments are worth what they were worth, right? And that's what creates the dislocation. So it's how long does that period persist? How long does it take before, if everyone's had to go raise money for all their companies today, would you also see a decrease in value of those? It's to the benefit of the fact that we don't have to do it right away, that valuations remain where they are.
I've always been curious about the sort of disconnect between, because at the center as you know, we've been involved with real estate tech since early teens, and the VC operates differently than real estate. In real estate, our world is this long-term world. We build assets to last 200 years. We depreciate them for 40. And we put debt on for 10 or 15 or 20. How do we? But technology is all much quicker. There's much more velocity, and the expectations are sometimes different. Do you think we're able to overcome those the difference in the business models?
I would say real estate right now is dealing with a very precipitous shock, in the sense that despite the fact that these assets may be financed for 30 years, you're dealing with a revenue reduction in the form of non-payment of rent across commercial, residential, retail, that hits you immediately.
That's a good point. It happened overnight.
And so I think that if I might sort of make the optimistic case for prop tech, there's a whole host of solutions in real estate, construction, retail tech that are all about automation and about reducing costs. And we may actually find that real estate owners use this time, unfortunately, because they have to reduce headcount, to embrace technology-based solutions as a way to reduce their costs, because as their revenues are coming down, in order to stay compliant with various covenants on their debt and so forth, they have to hit certain margin profiles, and the adoption of technology may be one of the only few strategic, or I guess tactics that they're able to take to do so. Mm-hmm. The challenge with that is that making these decisions on the real estate side requires attention, and right now we're seeing a dearth of attention to technology because they're trying to get their handle on their core revenues, and that's where everyone's minds are at right now.
Daniel, welcome back.
Thank you, Steve. Can you hear me now?
Yeah, we can.
Okay.
So we were, Merritt, did you have something to say about that?
No, I mean, the only thing I would add is, I think the bull case for coronavirus for startups and some of the entrepreneurs on the line is just that this can be a major catalyst for change, which I think is another way of saying what Dave just articulated. And I think the worst thing in the world for startups is stasis and inertia. And what we're seeing across our portfolio is sort of a reignition of interest in tools that can help real estate companies streamline operations, operate more remotely, save cost, all the things that Dave just said. And, I think hopefully the solutions that entrepreneurs are building are higher on the hierarchy in terms of the magnitude of impact they can have from day one. And I think if you can make a really compelling pitch around ROI, some of those companies may capture the attention of prospective customers who probably just weren't prioritizing it before.
Mm-hmm.
Yeah, I mean, building out, I think the nice to have, need to have equation, which is really the one that you're always walking as a startup. They always start out as something that's nice, and then fundamentally you believe it's going to become an essential part of people's workflow. To the automation point Dave just made, there are capabilities in the technology that are far ahead of what's been adopted by the market. People may have seen that before as a nice to have they weren't willing to do. Now recognizing that they need to add more automation, have less human dependency, those become higher priority purchases.
Yeah, and just to put this into context, I mean, we've just recently have heard from a few companies of some specific examples of this are virtual touring of real estate spaces. I think for a lot of people historically has been considered a nice to have, not a need to have. And all of a sudden those companies are garnering a lot of interest. Self-guided tour capabilities for apartment rental building owners is another area that's getting a lot of attention. Remote notaries who can sign, that enable both consumers as well as real estate folks to sign documents remotely, is all of a sudden accelerating. So I think there are a lot of pockets of prop tech that can exploit this moment.
Yeah, adding on that, like we talked about the immediacy of the impact, and I think a lot of people would agree. I believe it was Travis who said this was not a cause of structural shifts like the '08 crisis was. And so if we get a bounce back that is also relatively immediate, I would urge founders to remind them that the fear is temporary and that ultimately we'll come out of this. And so think through how to take advantage of the bounce back. If you're in a position of financial health where your competitors might not be so lucky, you should try and capitalize, because there's going to be very few opportunities like this to pounce.
Maurice Werdegar from Robertson Stevens says, historically, we've gotten our best companies during tough times. And I look back at before anybody called this prop tech, at the handful of companies early on were possibly the result of a tough economy. These were solutions and ideas that came out of a very difficult economy. And so perhaps this is what the future holds for this particular cycle as well.
So it sounds cliche, right? We like many say, but we really believe that we're very founder first. And I think one of the reasons why you see the best companies come out of difficult times is those are founders who are willing to start businesses in those times, and they see the opportunity to take advantage of a market when others are fearful to do so, right? And so we know how hard it is to build a company from scratch. Dave did it, build it to a big company. It's a really challenging thing to do. And when times are good, it looks easy and lots of people want to do it. When times are tough, it is really only those who are willing to sacrifice the most who can actually build the kind of companies that we're talking about that reach venture scale that we're all interested in.
Here's a question from one of our attendees. Heard that Roofstock, which apparently is a Bain portfolio company, and so you may or may not be able to comment, but apparently had a 500% increase in traffic. 10x has a higher trading rate than pre-COVID for March auctions. Any other real estate tech doing okay or even well? Any comments anecdotally on companies that have performed well in this uncertainty that you can talk about?
Yeah, I mean, I probably can't comment specifically on Roofstock's performance, but I think there is a business that we've gotten to know recently called Material Bank that is doing quite well. And Material Bank is a B2B marketplace for material samples. So they enable architects and designers to order samples of wall coverings, flooring, paint chips, etc., through a centralized marketplace from a bunch of different suppliers and manufacturers on the other side. And as you can imagine, I think in a work from home environment, such a marketplace has enabled the architects and designers to continue their work, where a lot of those people may have had access to physical resource libraries in their workplace and didn't necessarily need to order as many samples. In a work from home world, they've needed to do so in sort of greater numbers.
Right.
So that company has some beneficial kind of elements to it in this environment.
Anecdotally, there's a lot more traffic on the residential tenant engagement apps for sharing information and creating social networks in buildings. Other observations or anecdotes, Dave, Daniel, Travis?
Yeah, I mean, so we've been investing recently in companies in the indoor air quality space, right? We have a long-term thesis that becomes a really important aspect of what is delivered in the built environment. And our most recent investment is a company called Enverid, and I would say we've seen a dramatic increase in interest as Enverid is the only ASHRAE-approved technology to clean air and deliver measurable indoor air quality. Right? And so I think as people think more holistically about, there'll be renewed interest in the WELL standard and what are the kinds of things that help support delivering on the WELL standard.
I think I think construction tech is interesting. The majority of construction takes place outside. You also have kind of this natural social distancing with folks operating machinery, not in an office sitting next to one another. We've seen many states in the Northeast shut down construction completely, while other states in the Midwest and Southwest are open for business. But I think this will likely speed up the adoption for a lot of the technologies out there that allow developers to manage their sites virtually, right? So drones, computer vision, wearables, sensors, all of those things. I think this will help accelerate the adoption. Construction labor here in the US has been an enormous problem for us. And in terms of anecdotally companies who will receive a macro tailwind as a result of this, we have one company in stealth that's building the LinkedIn for construction. They're incredibly well positioned when they ultimately launch probably this summer, because I imagine a good chunk of the construction labor force will have just been displaced.
I'll share just a few similar anecdotes. We have a construction tech business called OpenSpace.ai that's seen their demand inquiries spike, dramatically. And part of it is that they enable fewer trips to the job site. Now, construction was deemed an essential work, function in California, at least for commercial construction. And so work continues, but to mitigate risk, you can adopt some of these remote monitoring solutions as a way to increase safety and also just increase quality of communication. We have a few other companies that deploy automation to remove things that had to be done on site. One interesting example is the virtual roadshow that is now being required both in the public market, for like investment bankers taking companies public, but also things like placing commercial insurance. There are software companies just like Zoom that will become critical to sort of enabling these types of virtual roadshows. We have a stealth investment in a company in the insurance space that's seeing a ton of demand, because usually the insurance industry gets together several times a year in London and in Bermuda to basically place policies, and now that world is being moved offline or online at a rate that is kind of dramatic, and previously one would not have guessed that they would have been able to shift so quickly, but this is becoming as a requirement rather than anything else.
Right. One of our attendees mentions that digital marketing companies in India are seeing far greater traction in these times, which will lead me into the next question I have about international, but also to mention here another anecdote from Eric Graham at CrowdComfort. They've had significantly increased activity for workplace sanitation and cleanliness. So I would imagine if you've got, the assets are empty of people generally, but there's still a lot of work to be done. So no doubt that part of that activity continues on, if not even more so. But on the comment in from India, how might this, and are you observing differences amongst countries, differences amongst geographies within the US? Any thoughts on that? What can we learn from that, if anything?
So we have a couple of large construction-oriented companies that are LPs, and I would say that, in our checking with them, they've seen this ripple effect, and it's one of the things that frankly gives us optimism of the immediate shut-off of work, particularly on construction sites, as it rippled across from Asia through Europe, and how quickly, and the different way in which that's come back, right? So Germany had a big down spike and then came back very quickly. South Korea came back almost very, very quickly. Other countries, Spain, Italy, for obvious reasons, are struggling too. But I think it speaks to immediately people putting into place new safety standards to try and have a better work environment on construction sites in particular, to follow better safety protocols.
Mm-hmm. Travis, actually, that was a question that was also asked, was about safety protocols and standards. How can we ensure that those get maintained as we move to this kind of remote world?
I'll give you some examples. So we have a portfolio company called SmartVid that uses computer vision to look for safety incidents and safety monitoring on sites. Historically, that's looking for trip and fall hazards, unsafe ladder, unsafe conditions, PPE, such like that. We quickly were able to develop a set of models that would be able to detect and measure distance between people and people in groups. right? And so that's a way to remotely alert to, are people staying adequate distance from each other? Do we have people convening? How do we do training to make sure we avoid that sort of thing?
Other thoughts from the panel? On that, Merritt, do you have, how diversified geographically is the portfolio?
I would say, well, if you look at our venture portfolio as a whole, we, probably 95+% of our investments are based in the US. So we tend not to look internationally. To the extent we have international exposure, it's usually companies that are based in the US or have a strong presence here and may also have some presence abroad. So I'd say heavily concentrated here. And then within the US, we have pretty good diversification across the states. So we like to invest in companies outside of coastal areas. And many of our prop tech companies happen to be outside of coastal areas. But I think, we haven't seen any notable advantage to being located in, Arizona instead of New York. I think at this point, the COVID restrictions have reached such a national scale that at least our companies are sort of experiencing them pretty equally.
When it comes to borders, I think we have been able to observe how real estate tech has unfolded in different countries and on different continents. At the one hand, there's a move to try to be less global given the pandemic, and borders are are in the conversation more regularly. But does this serve to democratize the startup world? Since we're looking for solutions regardless of where they come from around the world?
I think it certainly helps, Steve. I know as a fund, so our model is to lead rounds, be very active with our portfolio companies. And so even though our docs allow us to invest internationally, we've only invested in the US and Canada. We've looked at a few European-based companies, but just haven't been able to get there. And that's mostly due to the fact that we are so hands-on. And being across the pond obviously makes it harder to add value to the portfolio companies. But if we're in an environment like this that extends for longer than we think, I think you're absolutely right. It could potentially democratize that way of thinking. And funds like ours who have those hands-on models, we're going to have to think differently about that, because there's no difference besides time zone versus being online virtually with a founder in New York versus a founder in London.
Mm-hmm. David, were you going to say something? I didn't want to interrupt.
I think the counter to sort of whether this creates a democratization opportunity for startups that are not based in sort of hotbeds of innovation is so much of the selling right now in the B2B space, and including the selling that goes on from a startup to a venture firm, is benefited by whether you've had a pre-existing relationship with that investor or with that client before. Mm-hmm. And so I guess my fear would be, if you're a company that has not had those relationships with those capital providers or those customers before, it's harder to build that relationship now remotely. We have companies that are not based in the coastal markets that have the benefit of sort of lower cost of operations and a combo of just rent and people costs. But I think one of the things that this crisis will show is that because of the broad ability for people to work from home in the knowledge worker space, some of those sort of valuation, some of those cost dispersions may in fact actually contract, as a software engineer in Denver commands the same salary as she would get in LA or San Francisco or New York. And even, a really talented team in an abroad market like in India, might be more expensive than you would think. And so I don't think we know yet on whether there's any advantages or disadvantages for where the companies themselves are located. I just wouldn't discount how difficult it is to go from scratch in a totally remote environment.
Right. That's a good lead into a question that came in. How sensitive do prop tech companies need to be with respect to sales and business development efforts during this time? So a little bit of a twist on the discussion. How You know, it's hard sometimes, I think, to talk about business development and opportunity in the face of a monumental human crisis. So any thoughts on how you do that sensitively and thoughtfully, but effectively?
This is a tricky one. I think you've got to approach BD and sales with a degree of empathy, which is imagine yourself in the recipient's shoes. Are you providing value to them in your pitch? Can you bring them some new information maybe that they didn't have previously? Can you share with them how you might reduce costs, increase revenue in a more sort of objective way, perhaps, than I think a lot of people historically do sales or BD. I think those are required if you want to get responses. And then you just have to factor in the fact that people working from home, especially those that don't, you know, that might have kids and don't have childcare, like it's just double difficult to find the time when you're dealing with sort of hair on fire situations. So it does require a modicum of patience, and I would say it requires a double dose of empathy.
Mm-hmm. Other thoughts?
I think that's well said. If you genuinely, authentically have a solution to some of the problems that people are dealing with in this immediate situation, then I think you can make progress. But if you're trying to take people away from dealing with the problems that they're, you know, with their families or, you know, their staff, their financing, then, you know, you're really barking up the wrong tree.
I mean, I would argue, you know, if companies approach it with a really human mindset and say, we are ultimately solving a pain point that may result in cost savings or what have you, whatever the value proposition is that the company's offering, that ultimately will free up resources and time and attention to be diverted to other higher needs, which may include, you know, human needs in this pandemic. And so I think there's actually a really strong social case to be made to be adopting some of these solutions right now that may, on the face of them, just appear to solve business problems.
And do you think we may see more collaborations, maybe not formal mergers, but more collaborations both within countries and across countries to share technology? Does this accelerate the transformation of the prop tech category? I think the answer is probably yes. I just don't know what it looks like.
Yeah.
Oh, I caught all of you off guard with that one. By the way, that was a question. That was a question that came in from an attendee. That wasn't mine.
I don't have a mental model around collaboration across companies, across countries. Like, I guess I would need to see some examples of where that's been done well in the past to understand if that's going to be something that's going to happen more of in the future. I think everything is harder today, right? It's not as easy to get on a plane when you've got countries that are actively limiting the people who can come in and have to quarantine. It just makes international commerce harder. I guess by the same token, services that can be procured, sold, built in a totally virtual environment stand to benefit because it's less hard for them versus folks that are trying to do things that have a real world service component.
Mm-hmm.
I also think it depends how you define the word collaboration, right? Like, I think that there's going to be a lot of M&A that comes as a result of this. I think there will be some sort of capital markets freeze, and we're probably already in, call it week 2 or 3 of maybe 30 or 60 days. And yes, some deals are getting done, but most aren't. Like, you know, I was reading that, you know, CoStar recently drew down on a $750 million credit facility in anticipation of increased M&A. And I think you'll see a lot of the same in property management, right? Yardi and MRI have eaten up a lot of startups over the past couple of years. I think MRI announced another acquisition last week. I think residential brokerages, right? You've seen companies like Compass buy for growth. A lot of these incumbent residential brokerages have been laying off a lot of agents. So yeah, I agree with David. I also don't have a mental framework on how this goes across country, but I do think, you know, all depending on your definition of collaboration, if M&A falls within that, I do think we'll see a lot of M&A activity over the next couple of months.
Yeah,
we've already seen a bit of a transition over time as the space evolves, where everything was very proprietary, and there's been increasing API sharing has been going on. There has already been a shift toward greater collaboration. I just wonder if maybe it'll accelerate. Travis?
Yeah, I was going to say, I think the one space where I think we will see it transform and maybe accelerate is around supply chain, right? And we've seen huge supply chain disruptions all around the world in AEC, and bringing that back online. So it's going to require more transparency and better collaboration between all the potential participants. You know, there's a lot of talk right now. Are we going to see reshoring happen in certain industries? Maybe, maybe not. I don't know if I buy that, but nonetheless, you're going to need better alternatives to keep the engine moving.
Right, right.
Yeah. I also think you can approach this through the lens of the sort of build versus buy versus partner framework that a lot of companies have to ask themselves when they're looking at adding a new capability to their product feature set. And I think at least what we've seen with some of our companies is there is an increased willingness to partner where maybe before, with the benefit of time, some companies might have wanted to vertically integrate their product and build things in-house. Now, in certain circumstances, time might be of the essence, such that it makes more sense for them to partner and take advantage of an opportunity really quickly, given the needs of the market, rather than build it in-house and use the 6 to 12 months to do that.
And I think to be clear, we're going to see, because of the difficulty in accessing capital from new players who don't know your market, don't know your team, we're going to see a lot of companies fail. And those companies that had promising product, technology, people will be the targets that Daniel was talking about for those better capitalized companies.
I'll take the counter for a second. I don't think we're going to see a lot of M&A over the next few months or quarters. I think there's a very simple explanation for a lot of it, which is, for as long as the companies can't travel to actually do their due diligence and meet the team and get a sense for the culture of the organization, it's just very, very difficult to make a large purchase decision, even a small purchase decision. The second compounding fact is that the companies that are going to be in sort of distressed situations are almost to a T cash burning. And I think the appetite for later stage companies that may have the balance sheet to do these acquisitions, to take on cash burning enterprises, is diminished as well. And then the final component is that there's a lot of talent on the sidelines right now. You have very high growth businesses over the last 24 months that have just laid off a lot of people. You know, think about all the companies in the scooter space, in the travel space, hospitality, you know, retail. Every day we're seeing companies that are laying off engineers, product managers, designers, folks that have historically been in very high demand. And so the opportunity cost of, do I need to buy this team or can I just hire these people, has that trade-off has become far more narrow, I guess. And the result of that is that I think that any acquisitions that we do see are going to be extremely low priced. They're going to be extremely distressed. And I don't think there's going to be a lot of them.
Yeah, I would certainly agree with Dave that they will not be good transactions. They won't be one.
Yeah, I guess my question is, like, how important is the culture in some of these smaller acquisitions, right? So I completely agree, Dave, with you in terms of it's harder to do due diligence when you're on site. But if a lot of these acquisitions are distressed, then you're really just buying the technology. Even though there is a lot of talent on the sidelines, you know, it still takes time to build the tech. And so there's existing tech to acquire at distressed prices. You know, does the culture really matter that much? Do you really need to be on site to evaluate the technology? I don't know. It's a valid point, but
we haven't seen a lot of pure technology acquisitions in our category of the last decade. Like these acquisitions are always justified because they don't have strong EBITDA with some combo of the IP, the actual technology, the team, the sort of replacement cost of how long would it take me to build the equivalent. And some of that stuff is accessible, you know, publicly. A lot of it requires you know, getting in to the weeds, and that requires time, you know, often full days with engineering staff and so forth. And and it's harder to do that remotely. And then finally, it's very difficult to price that stuff right now because of the severe value shock that we've seen in the public markets. Everyone knows that current cash is worth a lot more today than it was, 60 days ago. Perhaps, I don't know, I've chatted with some of the would-be acquirers in the space recently, and almost to a T, they've all said, just like LPs and venture funds, we're taking a pause for 60, 90 days. And if your startup requires that your sale happen in the next 90 days, it's going to be really tough sailing.
Yeah, I agree with that.
Yeah.
Next 60, 90 days is hard.
So you mentioned technology. Here was a question that asked about, to get the panel's perspective on machine learning and AI specifically. What might this current situation do to accelerate the adoption? And then also what's realistic to expect? Because it's one thing to accelerate the adoption, but if the underlying technology doesn't support what we're trying to get it to do, then that doesn't help us either. Thoughts on AI and how it is impacting the category?
I think this is a bad time for ML and AI startups. And part of the reason why is that people often underestimate how much data these companies require to really get their solutions to viability. And that data almost always necessitates a large capital investment to build the data infrastructure to grab that data. I was chatting with a former employee of mine at Flord who now does AI infrastructure work at NVIDIA. And he's helped a few companies that I've introduced him to. And he says, to a T, these companies underinvest in data infrastructure. How do you build a data moat? How much money do you spend in acquiring proprietary data, cleaning it, tagging it, and so forth? And AI companies that have been less capital efficient, which is, I think, many of them, are going to find that the capital markets have tightened. And the less sort of data intensive, the less research intensive startups right now that have a little bit more agility to get their businesses closer to viability are in a relatively stronger position.
Yeah, just piggybacking off of that, I would say that the companies that find themselves in a favorable position right now are those that can prove an immediate ROI on their product. And I think in the case of many AI and ML companies, there's just a lot of lead time required to prove the ROI, or a lot of kind of heavy lifting on the part of the company to build out use cases internally. And they won't necessarily see that immediate payback. So I actually think of a lot of the AI and ML companies out there as being more, or possibly seeing a more positive reception in a bull market environment where there's a little bit more willingness to experiment.
How about if we make the distinction, though, between AI or ML startups and applying the technology in an existing company that's trying to accomplish something? Travis?
So I think the distinction always comes down to what is the product? Am I selling you an AI ML engine so that you can do something? Runs into the problem that Dave talked about, which is based on what data, right? If you've baked it into an application that is leveraging ML and artificial decisioning to do something, then I think those companies are perfectly viable, right? So 75F uses a sensor network to optimize the HVAC air quality distribution in a building. It's their sensors. They have all the data. They don't position it as machine learning for HVAC optimization. It's just optimizing your air quality and lowering your total cost of energy.
And to bring it full circle to the earlier part of the discussion, as we start to do more, better, faster, autonomously, perhaps then that is a good fit.
Yeah, so we have a investment in a company called Built Robotics, excavators and bulldozers that are self-driving technologies. Nobody cares what it takes. Mortensen hires them to dig a hole, not because of how they do it. They just get to do it in a better fashion because they don't have to have a human operator and can operate 24/7.
Right. While we're on the topic of technologies, there was Michael Beckerman's blog post editorial from maybe 2 weeks ago, just discussing what kinds of ventures will benefit from the uncertainty and maybe from this new world that we're moving into. He listed anything digital, frictionless, involving less manual intervention, to the point we were just discussing, AR, VR, and digital twin, construction tech, platforms. What do you see as the, I hesitate to use the word opportunity because I want to be sensitive to what's going on right now, but what might get accelerated? What categories do you find interesting at this point, all of you?
Yeah, I touched on this before as it relates to construction tech. In terms of accelerating adoption, adoption has been the biggest issue in construction tech. There are so many anecdotes we have from large construction firms who try and mandate from a top-down level to their GCs or their subs to use a certain technology, and they get all sorts of pushback. And so, some of the examples that I've been thinking about are anything related to how developers can virtually manage sites. So like drones, computer vision, sensors. I think this type of environment will begin to accelerate the adoption of those technologies.
Other thoughts from the panel?
I think here at Bain, we have a pretty strong practice in fintech alongside prop tech. So oftentimes we look at companies through both of those lenses. And I think one area where there's a lot of opportunity in a standalone basis is in fintech, but that also applies to prop tech. So if you think about things like people making rent payments or their monthly mortgage payments even, I think we're going to see an acceleration of adoption of digital solutions to do those things. And similarly in other parts of the payments industry, like construction financing perhaps, there are some sort of disruptors in that space that try to streamline a lot of the workflow across stakeholders and reduce just the amount of paper that's involved and manual work that's involved to get a loan for a construction project. Things of that nature we think will benefit in this environment potentially.
Yeah, I mean, we started the firm on a very simple premise, which is we were going to add another 2.5 billion people to the planet over the next 30 years. And there was no way that we could design, build, and operate the physical space that they would need in the way we have in the past if we wanted to have it be sustainable and resilient. Our premise was that technology would be necessary in order to make all of those processes a lot more efficient. I think we're just going to see this as an accelerant to how do we add more digitization to each of those phases of the life cycle.
Yeah, Dave?
I mean, I'm trying to think of
which categories do you find, are you intrigued by? Maybe before this happened, you might have been intrigued by them. Maybe not so much now, or maybe something new.
Yeah, I guess I'm trying to figure out how to make this specific enough as to not be too vague. But I think there's a few companies that we spend a bunch of time with that are automating various processes that used to require a bunch of approvals from one analyst to an associate to a partner and so forth, where there's a lot of reporting that's built into the software. So the software solution replaces this manual process. And there's a lot of software that's sort of automates various workflows, just digitizes them, takes them off of offline workloads. And then on top of the workflow automation, introduces new aggregated data insights that you can then sort of make as either as a sellable thing or a thing that augments the core product. And then finally, things that have the ability to unlock marketplace opportunities where you're connecting two parties that have historically been brokered by a fee-taking intermediary. I think companies that are thematically addressing problems in those areas across all elements of the real estate cycle, from acquisition to maintenance to disposition, are broadly interesting to us. I think unfortunately what's been really hurt by this period is that the technology enabled services that have a lot of physical world services, those are broadly negatively affected.
I think that Dave's point on the technology enabled companies, like since WeWork, we've already kind of seen the multiples of those business come down compared to more traditional SaaS models. And so I think to Dave's point, this probably only puts further emphasis on that.
Well, we were already moving toward certain platforms, and I think the lines were getting more blurred. I wonder if maybe there won't even really be a prop tech category in the future. It might just be enterprise software again. But we'll wait to see how that unfolds. Travis, one last question for you on this. I wonder if the transformation in the construction industry was being driven by the shortage and the acceptance of certain technologies that previously might have been threatening, that now, because of the shortage of labor.
Right.
Is that genie out of the bottle, or do we now go back to a more labor-focused construction industry?
I don't think we ever go back to a more labor-focused industry, and there's a couple reasons for that. So we permanently lost 1 million construction workers in the downturn in 2008. Whether or not it happens again this time, we don't know. But the demographics are such that you have something like half the construction workforce is over 55, and only 5% of it is millennial. So we have to create automated solutions in order to just keep the trains rolling. Meanwhile, we have to build, I think Autodesk says 13,000 buildings a day for the next 30 years. And so that's why we have some international investors, because we want to pay close attention to what happens in Japan, right? Japan's demographic situation is further ahead of the United States in terms of labor availability. So I think that's a big macro trend that continues, and we will fill it in with technology, and we'll probably fill it in with technology faster now.
Right. Thanks for that. So great conversation. I have one final question for everybody to weigh in on that always comes from the attendees, and I'm always curious to hear the answer. For a startup, what should they be focusing on now, and what should they be looking toward in the months to come? We've danced around it a little bit, but if we could just close on your perspective, how would you advise a startup in the coming months and perhaps year?
So I'll jump first. So Paul Graham says that startups die for one reason: they run out of money, right? And so right now, I think the most important thing for people to be focusing on is their survival. Whatever runway they had before, they need to have another 6 months, and whether they can get that fresh capital from the outside, from looking at their own burn rate and looking at their current investors, that's really where the focus needs to be until we have better clarity to when the uncertainty ends. And unfortunately, as I said in the beginning, I think we're still in the middle of the storm.
Yeah, to add to Travis, I think in the short term, we're telling all of our companies, reduce monthly burn, pay attention to the legislation, the payroll loans, raise more capital if you can. I would say try and be accommodative. If investors are willing to put money in at last round's terms, I would recommend doing so and kind of add that buffer. And I think also culture is important here. With every strategic decision that a founder makes, especially with everyone being remote, culture can take a hit. Do your best to coordinate virtual happy hours. Make sure you're being transparent with your employees, and try and take a optimistic view.
Yeah.
Merit?
I would echo what Travis and Daniel said. And I would say in addition to that, it's just worth remembering that this is an opportunity, I think, for founders to revisit fundamental questions about their business that maybe a month or two ago they were too busy to think about or too distracted by growth initiatives to think about. And for the next quarter or two, and maybe 3, all companies will be forgiven for having soft performance. And so people should use that as an opportunity to think about new products they were thinking about building and just didn't have time to get around to, or changes to the team that they should make, and other kind of difficult, sensitive decisions that in a normal environment they might have procrastinated making, but now they will be, they sort of have an opportunity to make bolder moves and be forgiven for them if there's a revenue impact.
Yeah, that's a great point, Merritt. Thank you. And Dave, I'll give you the last word on this. Your thoughts on, because you've been a founder, you've worked with startups, you've funded, you've been everywhere. What words of wisdom can you share at this point?
The worst question to go last on. All the good stuff's already been said. I guess the only incremental thing I would say is your relative advantage as a startup right now is your agility and your speed of execution. The bigger companies in technology or in traditional, they're not going to be building a lot of stuff right now. They're going to be focused on, defensive mechanisms. And so if you've already done all the other stuff that people have advised you to do, if you've cut your burn, if you tried to extend your runway with, your existing investors or new investors, the final thing to do is really write good software right now, because when this comes out, it's going to be mayhem. Like when the shelter in place is removed and we try to get back to some semblance of normalcy, everyone's going to be competing with everyone else's attention for time and for capital. And so if you've made relative progress along those lines, you built that hard to build thing during sort of the time of quarantine, I think you maximize your chance of long-term success.
Great. David, thank you for that. I'll say thank you to Daniel and to Merritt and to Travis. It was a terrific conversation. Good luck and be safe out there. Over to Ash. Thanks everybody for taking your time to share words of wisdom with us today. It was a great conversation, and I'll turn it back over to Ash.
Thanks, everybody. Thank you, Steve, and thank you to our amazing panelists, Daniel, Dave, Merritt, and Travis. And for anyone that would like to learn more about CREtech, please tweet us at Discover CREtech, or email us at research@CREtech.com. We hope that you will join us at our next event, and we hope to see you guys soon. Have a great day, everybody.
So long.